Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, welcome. We have a huge episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. There's a lot happening in markets. We're going to unpack it all. Today, we are going to cover the news as earnings season continues in America. And we're also going to cover some good economic news that has come out of Australia. Then we've got our latest episode of Pimp, My Portfolio, where an expert reviews the portfolio of a community member. And finally, we're going to take a deep dive on tariffs, because there's been a lot of noise. There's been a lot of ink spilled on what's happening with tariffs. But earnings season has given us an insight on what has actually impacted so far. So We're not going to talk about forecasts. We're not going to talk about what could happen, but we're going to say we're going to ask where has the effects actually shown up so far.
Love it. Well, let's get into it.
News and markets.
So today we're going to cover off earnings season, as you said, Ren, Aussie inflation, and you have a question. Have we reached peak capitalism?
Yeah, I've got something to show you. So we'll hold that in reserve.
Yes.
Let's start with earnings season. Every quarter in America, we get the news on how listed companies are going. In Australia, traditionally, it's every half year. More and more companies now do report quarterly. But in America, we get a flood of information. More than half of the companies in the S&P 500 have reported so far.
Yeah.
So the big question is, what have we learned?
What have we learned? I mean, it's a tricky scenario at the moment because we're getting the quarterly reports that are coming through. We're not seeing the full effect of what's happening over in the US. So overall, reporting has been quite positive.
Yeah.
But the forward guidance that companies are putting out, how they feel the next quarter is going to go, is one that is full of uncertainty.
Yeah, because they're reporting January to March numbers, the first quarter of the year, and Trump's tariff announcement came out on the 2nd of April.
Yes.
There are a couple of, big tech has really caught our focus because they've had pretty soft years in terms of share price performance, but we looked at Google in a previous episode, and their profit was up 46% year on year. Revenue grew. They were looking pretty strong despite investors selling off. We've had a couple of other big tech names report. Meta and Microsoft caught our attention because they were both surprisingly positive as well.
Very positive. Let's get into it. So we'll start with Meta. Revenue of $42 billion for the quarter. That's up 16% year on year, beating market expectation. Profit, $16.5 billion for the quarter. That's up 35% from a year earlier.
And just hold on that profit margin. That's a 38% profit margin.
Yeah, it's wild.
Yeah.
Advertising revenue, just over $41 billion for the quarter. That's up 16%. Interestingly, their price per ad up 10%.
Okay.
Good news there.
Well, good news for Meta shareholders.
Yeah. In terms of outlook, they project revenue for the second quarter of 42 to 45 billion. So continue to grow revenue there. And Zuckerberg, he said that they have seen considerable progress in AI, particularly with Meta AI and AI glasses, noting that Meta AI now has nearly 1 billion monthly active users. When the place that I see it most used is actually in WhatsApp.
No, the place that I reckon this is one of there's a number of numbers that get reported which are bull. This I think is almost the most bull number. I'm not going to swear, but I'm getting close to it.
Yeah.
Because anyone who searches on Instagram is using Meta AI.
What do you mean searches?
Pull your Instagram out.
Oh, I know what you mean.
And it's no longer a search when you're like looking for someone's account or something. It's ask Meta AI.
Yeah.
Actually, now that I say
I know what you mean. They've just toggled the search function into Meta AI.
Yeah, well, now that I say that, our business account is actually still search. My personal account is either Ask Meta AI or search.
Yeah.
And so technically I'm using Ask Meta AI there.
Yeah. I used Meta AI recently to scrape our boys' WhatsApp group. To be like, remind me of a lot of things that have been said, and it was really good at it.
Interesting that you haven't leaked any of that to us yet.
It was for I have. It was for the agenda of our upcoming event.
Okay, nice. Yeah. Anyway, Meta AI.
Big news.
I'm a hold on Meta AI, but Meta's numbers pretty impressive again.
After hours, the stock is up about 5%.
All right, so that's Meta. Microsoft reported at the same time, and they also had a pretty impressive set of results.
Absolutely. Beating expectations, as did Meta. Revenue of $70 billion, up 13% for the same time 12 months ago. Profit, almost $26 billion for the quarter, an 18% increase.
So that's a 37% profit margin, similar to Google's 38 or Meta's 38, but just like these are so much higher than a standard S&P 500 company, but even they are higher than these Mag 7 companies historically.
Absolutely. Yeah, it's wild numbers. Well, not wild, but yeah.
Pretty wild.
Yeah. People criticize us for constantly focusing on the Mag 7. This is why.
Yeah.
Cloud revenue, $42 billion, up 20%. And their Azure business, their cloud business actually grew 33%. In terms of outlook, again, focusing on the innovation in AI infrastructure with cloud and AI seen as huge growth drivers. Their CEO, Satya Nadella, the story is AI and their ability to innovate across the AI stack, and they're seeing real demand for their cloud business. So, Ren, I just want to we are lucky enough to get to speak to some of the biggest and best minds in the investing world, and we went to a media briefing at JP Morgan and heard from one of their global portfolio managers, and one of the quotes he said was around the Mag 7 and their ability to just continue to generate huge amounts of cash, and that, quote, these companies are virtually impossible to compete with. So
that's why we talk about them.
That's why we talk about them.
Yeah, it is interesting though. I think you noted this on our Instagram last week. The breadth of expectations that we're hearing from the experts we speak to, because you're right, JP Morgan, we went and they were pretty bullish on the US. They thought there was fair value based on the last 20 years. They didn't think there was much of a valuation gap between Europe and the US. Like they were pretty positive about the US. But then we spoke to the head of fixed income at Schroders, and she was calling herself Dr. Doom, like it was like, get out of the US. This is historic. This is terrible.
Yeah.
We also spoke to a Pimco fund manager from New York who kind of like split the difference and sat in the middle and kind of thought that like things would normalize after the US midterm elections in 2026. And
just
like,
hold on.
It wasn't great or it wasn't terrible. Like the breadth of opinions we're hearing is pretty wide. And so, like, what are we as just regular punters to do with that information? I mean, my takeaway is, like, just stick to the long-term plan, keep dollar cost averaging, buy the dip if you've got cash on the side, and be globally diversified.
Definitely. Well, the dip's over. Hate to tell you.
We're what, down like less than 1% from Trump's Liberation Day in the US.
Exactly.
Australia's actually up from Trump's Liberation Day, which is pretty wild. But maybe that's a good segue to talk about Australia, because we got some more good news coming out of Australia. Australian inflation. So there are two measures of inflation that are worth knowing. The CPI, headline inflation, the Consumer Price Index. But then the Reserve Bank has a preferred measure of inflation called trim mean inflation, which is meant to measure underlying inflation. So it excludes things like the government giving everyone a subsidy for their electricity bills.
Yeah.
CPI has fallen back into the RBA's 2 to 3% target range earlier this year, late last year.
Yep.
But trimmed mean inflation for the first time in 3 years is now back within target. It came in at 2.9% for the 12 months to March.
Scraping in.
Headline inflation, CPI, was at 2.4%, so that held steady. But it is good news that underlying inflation is back within target.
Yeah.
And what that means for Australians is that markets are basically guaranteeing a rate cut in May.
That's the headline. Money
markets are pricing a 98% chance of a rate cut, Westpac have, quote, already locked it in.
Well, then they should pass on the interest rate cuts already.
They should.
If they're that confident,
Yeah.
be a leader.
That is actually locking it in.
Yeah, that's locking. Saying it's locked in means nothing.
That's like they should do sports bet early payout.
Exactly, early payout to all their holders.
So that's good news for Australia. One piece of not so good news, the credit rating agency S&P Global looked at both sides of politics spending promises and said that their policies from both major parties could risk Australia's AAA credit rating. So that's going to be a watch as we enter a period of structural budget deficits. At least that's the forecast. So that's a watch. Got to temper the good news with some bad news.
Nice.
All right, Bryce. Now, I said I was going to close this news out by asking you a question.
Yeah.
Have we reached peak capitalism? To do that, I want to show you this.
Got this wild startup pitch this morning. We're empowering the unhoused by turning them into mobile brand ambassadors. Instead of panhandling, they earn stable income by wearing high visibility branded gear in high traffic urban areas. We have a network of 100+ micro entrepreneurs for you to tap into.
Oh my God.
What do you reckon?
That is so sad.
So grim.
That is so bad.
Some American, probably in Silicon Valley, microdosing on LSD.
Oh my God.
That's pretty grim.
That is grim.
Yeah.
That is grim.
So that's my question. Have we reached peak capitalism?
We're getting close.
Yeah.
There's a new phase coming.
Revolution.
We'll leave it there.
Okay.
But I should say, Ren, if you want to keep up with all of the news headlines beyond what we've spoken about today, keep up with all the earnings that are coming through, make sure you subscribe to our daily newsletter where we send you a summarized version, a dot point version of all the important headlines that are making markets move straight to your inbox, 6 a.m. every day. There's also a podcast that goes with it. It's called Headlines by Equity Mates. It'll be in your podcast feed. That's not the only newsletter that we do. If you're a financial advisor or an industry professional, subscribe to Basis Points, a monthly email where we try and find those small improvements that compound into big outcomes. A link to both newsletters will be in the descriptions below.
Tariffs have been the number one story in the headlines for the past month, but a lot of it has been forecasts about what is to come. But we're starting to find out what has already happened. Here's the insights we've learned from earnings season.
That's right, Ren. There's been a lot of chat, but we're starting to see the rubber hit the road.
Yes.
In terms of the flow-through effect or the
rubber not hit the road.
Or the
in this
steel
case.
hit the water.
Yeah.
Or not hit the water.
Yeah.
Not enough rubber hitting the road.
So let's the way we're going to start this is by talking about where the transport impacts have been felt, and then the flow and effects onto companies.
Yeah.
A lot of this is going to be US and China specific because the rest of the world has kind of got a 90-day pause, and so there's a lot of preparing and a lot of contingency plans. But really, where the rubber has hit the road, or whatever analogy we're using, it's in the US and China. So let's start with where the transport impacts have been felt.
So, Ren, we'll start with shipping because that's been the biggest and most, I guess the most immediate impact. Some numbers here. So there's been a drop in capacity of over 250,000 shipping containers.
No, not a drop in capacity. The opposite. The drop in utilization of that capacity.
Well, yeah.
Like that much shipping capacity
Has been
was
taken out.
Pulled
Yeah.
of stuff that was booked to go to the US in April.
Empty containers have begun piling up in US ports. This is because we're seeing much lower volumes come through. The Port of Los Angeles, now we said we weren't doing forecasts, but obviously it's pretty important, have forecasted a 33% drop in incoming container volumes in May.
Yeah, and we know what happened during COVID where supply chains, there were containers piled up or ships backed up, and so then all of a sudden the steady flow of goods around the world slows. And if you combine, containers piling up at US ports already and then lower import volumes, all of a sudden you can start to see like bottlenecks emerge and shortages emerge, and that's going to be a concern.
Yes, absolutely. So then it flows through to the trucks that come and pick up the containers. Freight bookings related to port imports have fallen by 40%.
Yeah, freight imports.
What did I
It's just
say?
a confusing way to say it. The bookings for trucks to pick up containers from
Has
the port
fallen.
is down 40%
Yes.
month on month.
Yeah, it's pretty
Yeah.
wild. It's fascinating to see how quickly this kicks in.
Yeah. And also, interestingly, it's not just shipping and trucking, it's also air freight. So, air freight rates on Asia to US routes, so not just China to US, but across Asia to US, fell by up to 28% in the month due to lack of demand. So, I mean, like, the takeaway here is that, like, far less goods are being shipped.
Yeah.
And so then there's some specific US-China numbers we've found. So some of the major ocean carriers have reported numbers. So Hapag-Lloyd and Evergreen have reported between 30 and 70% declines in China to US bookings, and cancellations have surged.
If you look overall, though, Ren, at the shipping between China and US, shipping from China to US has dropped by roughly 60% in April alone. So pretty significant fall off. And air cargo volumes from China to the US have fallen 16% year on year.
So then the question becomes, that's been the transport story. There's some of the numbers that are emerging, what's actually happening so far, not what's being forecast to happen in the future. How's this affecting companies? So we're starting to hear more and more of that as earnings season carries on. I think the starting point should be 40 companies, not just in the US, but the majority of them in the US, have either cut or pulled their guidance altogether. For example, Porsche has cut their guidance. They lowered their profit forecast by 100 million euros, while other car companies, GM and Volvo, just ditched their guidance altogether. They said, we can't forecast what's going to happen for the coming quarter, so we're not even going to try. And it's not just car makers. Business as varied as Swedish appliance maker Electrolux, all the way to American food giant Kraft Heinz. They just cut their guidance. They said, we're not going to do it. Electrolux said, quote, every single prediction has proved wrong amid their sort of tariff-related planning. So they just said, we're not even going to try.
Yeah.
So that's kind of like the headline. Over 40 companies have cut or pulled guidance. But then there's some specific companies that are worth noting. One that I think is interesting is Smithfield's Foods.
Yeah.
A major meat processor. They've said now US pork is just unexportable to China from a price point of view, because I think in total, all of their tariffs are now 172% on US pork entering China. So they're just like, we can't do it anymore.
You'd think then cheap pork prices in the US.
You would think that?
Yeah.
You would also think those exporters are trying to find other markets.
Yeah, good for Aussie.
I don't think we take US, because you know how we don't take US beef?
True.
'Cause-
Yes, yeah.
Because of
They take our beef.
Because of our biosecurity laws.
Yeah.
That's just one of many impacts we've seen. Another one, Mack Truck.
Yes.
As American as you can imagine, they're firing 10% of their American unionized workforce at their plant in Pennsylvania. And I think this is, for me, this is symbolic of everything that's going on. Because American manufacturing plant in Pennsylvania is exactly who Trump is trying to help.
Yeah.
You know, that's the swingiest of swing states.
Yeah.
And this is, a Mack Truck is the American of American companies. But they're firing 10% of their American unionized workforce. Their parent company is Volvo, we should say. So they're not as American as American. But a lot of these American manufacturing plants are assemblers. They're not manufacturing from scratch. It's not like America has steel mills that are making the constituent parts.
No.
And so they're going to get hit by like steel and aluminum tariffs or aluminium tariffs, depending on where you are. So yeah, Mack Truck, 10% of its unionized workforce in Pennsylvania being fired. I think that's pretty symbolic of what's going on today.
Absolutely. A few other things to note, Ren. We've seen retailers in the state, they've actually front-loaded a lot of their inventory before April. What that means is they've brought in more demand, a more inventory supply in anticipation of these tariffs. They've then gone and started cancelling or pausing a number of imports due to the cost hikes since tariffs have come in.
Yeah, which correlates with what we've seen in the shipping numbers we spoke about earlier. They brought forward a lot of their inventory, and then that's why April's been so soft. Yeah.
I mean, there's a lot of headlines going around at the moment around empty shelves are about to appear all across the United States. So we'll keep an eye on that one. Procter & Gamble have raised their consumer prices across the board to try and offset the cost of tariffs. You may have seen as well that Amazon came out and wanted to display the tariff price or the impact of tariff on all of their goods on their website.
As like a separate line item on customers' receipts.
Yeah, just to be like, hey guys, we're not the ones, we're not pushing prices. It's because of the tariffs that this has happened. Trump came out and said that he was pretty unhappy with that.
No,
and so
Trump called Jeff Bezos and they resolved it.
it's unbelievable. So that's not going to happen. But there is one unlikely hero, though, of the trade war, Ren, and that is Coca-Cola. You wouldn't believe it. The beverage giant has reported its first quarter earnings, and it confirmed it would not be raising prices despite acknowledging that tariffs on aluminium was driving up the costs of its cans.
Coca-Cola.
Good on you, Coca-Cola.
Good old American company.
Good on you, Coca-Cola.
So I think, what's the takeaway here? The takeaway is there's so much uncertainty for so many so many global companies that a lot of them are just pulling forecasts or cutting their guidance because they're just unsure. But we are starting to see real impacts both on where companies can sell, how much they're selling for, like Procter & Gamble raising prices, but also we're seeing it flow through to jobs in the US. We should be clear, China, there's also been a lot of reporting around factories sending people home and job pauses or job cuts there. Goldman Sachs estimated 10 to 20 million Chinese workers are working on American export businesses, like businesses that export to America. So there's job impacts on both sides of this trade war. So really the takeaway is when there's a trade war, there's no winners.
No. So we'll keep an eye on this and keep everyone updated as we see how this plays out over the coming quarter. Because it's certainly not the end, that's for sure.
No. We're going to take a quick break here, and on the other side, we'll be back with Pimp My Portfolio, where an expert reviews the portfolio of an Equity Mates community member and suggests some improvements.
Welcome back to Equity Mates. It is time for...
Pimp My Portfolio. Pimp My Portfolio.
That's right. This segment is all about an expert reviewing the portfolio member of one of our community, reviewing the portfolios of one of our community members. And today we have Renee joining us. Renee, welcome.
Hello. Thank you for having me.
No, thank you for submitting. We're excited for this one. And our expert in the studio today is financial advisor from North Haven, Matt. Matt, how are you going?
Yeah, good, thanks.
Alrighty, well, as always, Ren, do you want to take us through Renee's portfolio?
Yeah, so Renee's portfolio is primarily 7 ETFs or indexed funds. So we've got Vanguard Ethical Conscious International Shares. We've got BetaShares Global Sustainability Leaders. And then we've got Vanguard International Shares as well. VDHG, coming back to Australia, we've got Vanguard Australian Shares. And then we've got some infrastructure, Vanguard Global Infrastructure as well. So those are the ETFs. And then there's one stock, Lithium Energy.
Yes.
Yeah. So, Matt, we usually start with a nickname. So what have we got today?
So I've called this portfolio Sustainably Boring.
Oh, wow.
Right, okay.
And I'll explain. Don't take that the wrong way.
Don't take that the wrong way. Renee, how do you respond?
Yeah, no, I think I'm definitely well and truly due for a kick up the bum with this one.
Well, I don't think boring is a negative term when it comes to investing. But maybe tell us a little bit about how you came to put this portfolio together.
Yeah, so I guess a few years ago, I sort of thought investing would be a good idea, having absolutely zero exposure growing up. So that's when I started sort of DCAing into the international shares one. And then a few years later, we thought the ethically conscious was a good idea. So we dumped a heap of money into that. As you can see, I have attachment issues and I'm too bloody scared to sell anything because I know every time I look at it that there's so much crossover. So yeah, I'm basically like, I know I need to do something. I just don't know what.
And I guess, are you still actively putting money into any of these at the moment, or are you waiting now just to...
We are, yeah. So the Vanguard International Shares Index Fund is the one that I never stopped putting money into. So
Nice.
We've gone through a bit of a life change cycle the last few years. And then, yeah, so basically DCAing 1,400 a fortnight, 1,000 into the VDHG and then 400 into the International Shares Fund. We recently sold our house and we kind of don't intend on buying property anytime soon. So I'm kind of in a position where I've got a fair bit more that I want to put in. I just, don't really know what to do.
Sounds like you should actually get some proper professional advice from
that. Yeah. It's on the list. So, yeah, it was all fun and games until I had my daughter 2 years ago. And then, everything just sort of got a bit hard. I fell out of touch with life and the world. I just kind of kept putting into those two, and then still trying to figure out what to sell, what to keep, and what to put more into.
Well, Matt, knowing all of that now, what are your thoughts?
Yeah, so look, to backtrack on that name, I fully agree with Ren that, boring is good. If you're not someone who's watching the market closely, boring is better. So obviously a fairly high allocation to these sustainable ETFs. That's the big thing that jumps out here. These ESG ETFs really had
a moment.
They had a moment a few years ago. Yeah, as that's all become a bit more politicized, and there's been concerns around greenwashing or what's actually required to be an ESG company. I mean, WiseTech has shown up in a few ESG ETFs over time, and we can't say their governance has been squeaky clean with everything that's come to light recently. So,
I mean, the big shock for me was looking at the International Shares Index Fund, and then the, in quotations, ethically and socially responsible, like the top 5 holdings are just the same.
Exactly.
So that's what I was going to say actually is that Vanguard one, when you look at, say, the top 10, you're just buying the S&P 500 basically.
Yeah.
That ETHI, your beta shares one, that has some other more interesting names in there. So some of the top holdings, it's not just, the Mag 7, you've got things like Visa, Toyota, ASML, MasterCard, some more interesting ones. So if you're keen on that ESG and you want to keep adding to one of them, then I would go with ETHI. But as you've said, you're allocating mostly to VGS and the like.
What do you think about that as a dollar cost averaging strategy, Matt, allocating to those two in particular?
Yeah, look, VGS is about 80% US, VDHG is about 30 to 40% US, and VDHG also gives you some fixed interest, and I think there's a bit of property infrastructure in there. So it is more diversified. Honestly, I would just probably do VDHG. I wouldn't maybe worry too much about doing both unless you really wanted more US exposure. If 30 to 40% wasn't enough for you in VDHG, then adding a bit to VGS. It's constructed that way for a reason. It's a pretty sensible allocation. But like I said, it's got a few other things in it as well, VDHG, that rounds out your portfolio a bit more. So I would probably focus on that. Something that I did really like about your portfolio, which you hardly ever see, is you had some infrastructure exposure there. Most people just focus on Australian stocks, US stocks, but international stuff. To see some infrastructure was really good.
Is that something that I should consider putting more into? Because I guess that was sort of a quick question I had. It's like if I put a little bit into something and then, I haven't really prioritized putting more into it, is it even worth having it there? Or is it better just to simplify it and, just get rid of it and then focus on the big ones like the VDHG and, potentially this FE one? Yeah,
if you're really focusing on VDHG, I would just focus mostly on VDHG. Because it is that one-stop shop. The thing about the Vanguard Global Infrastructure Fund, VBLD, it's really heavy on electricity and pipelines. So it's done really well in the last year or so. But you probably wouldn't just have that as your infrastructure exposure. You'd want to round that out. Things like telecoms, toll roads, airports, rounding that out. And there's other ETFs that can do that. VanEck have some, Magellan have some. So if you are going to round out, you do that. But look, you mentioned that you're not looking at getting back into property soon. If you're really looking at putting some money into this portfolio in a short period of time and not just dollar cost averaging into VDHG, then I definitely support the guys in that getting an advisor to do a really well-rounded, properly constructed portfolio that has allocation to all those bits and pieces would make sense. That's not a plug. Speak to anyone you think can help. But I would definitely not just dump it all into one holding and call it good.
Yeah, it's definitely on the top of the list. Our house only sold sort of a few months ago, so I've just got the money in a savings account at the moment while we kind of figure out what we want to do with it.
Yeah.
And the other quick question I had was, do you think it's like not necessarily concerning, but it's problematic to have sort of everything in Vanguard? Because I'm much sort of like a simple person where I'm like, well, it's just easier to manage when it's all there. But is that, concerning in any way? Should we be having it in, with some other providers or things like that?
Look, if Vanguard goes down, we're all going down.
I
think like the proper answer to that would be, you've got a bit in beta shares there as well. So, there is a little bit across there, but yeah, Vanguard is just ginormous. I think you're pretty safe to keep it there. But yeah, all these other providers, Global X, all these other ETF providers have very similar products, and you could easily
the
diversify.
same underlying thing at the end of the day. So,
exactly. Yeah.
And Vanguard have what, 7 trillion under management or something. So
yeah,
I don't think there's an issue there.
Yeah, I'd agree.
I noticed with Vanguard, and this might be sort of a silly question, but they'll run like a high growth index fund, for example, and then that's the not listed version, and then the high growth ETF is the listed version. But when I look at them sort of from a basic level, it looks like they basically both do the same thing. Like, are you meant to pick one or the other, or are they a similar product except one's listed and one's not?
Yeah, I mean, you've got a lot of this unlisted stuff, and it's definitely not as pretty to look at. Like, I was like, what is VAN0111AU? I was like, oh, it's VDHG. Like, it's just the unlisted version. So it doesn't make too much of a difference. There's underlying differences in terms of the tax structure and how Vanguard are actually structuring it, but what you get is more or less the same.
To be really clear, like if you go on the Vanguard website for VDHG, as an example, there's actually a toggle where you can choose the ETF or the managed fund. Yeah. And so like the underlying investments are the same, but to Matt's point, there might be some structural
looking at
differences.
VDHG specifically, the management fee is different. So ETF is 0.27, the managed fee is 0.29. So slight differences. Underlying assets, I imagine, would be very similar, if not exactly the same. But yeah, slight differences. So worth having a look at.
Yeah. Look, large institutions and financial advisors like us will often buy unlisted versions, but that's because it's easy for us to get exposure to those. As an everyday retail investor, the listed equivalents are super easy. You can just get on your brokerage app, just buy it, and you've got it the minute you click buy, basically. So it doesn't really matter to sum it up, but there's not too much difference.
Nice.
Well, Renee, did you have any more questions for Matt?
Do you think I'm the two things I think I may be missing out on a little bit is maybe more of like a small cap type, focusing a bit more. I feel like it's all very heavily weighted into like the companies that form the top of the charts and the top of the indexes and stuff. More small companies, and also any sort of like all world ex US and Australia type stuff. I feel like I've got US and Australia, but that's probably it.
Yeah. So you've got almost 60% of the portfolio in the US when you look through the ETFs, about 20% in Australia, and then about 16% in other countries. So definitely a heavy skew towards the US. It really depends what approach you're going to take. If you're really just going to focus on VDHG, then you're getting a lot of that diversification through there. But if you did want to be more specific, then looking at, an ex-US ETF would probably make sense. And but basically keeping 3 buckets. You could have your Australian shares, US shares, and ex-US, which has a little bit of Australia, but like a couple of percent. So it basically gives you, all the key themes, the international, the US, and Australia. But VDHG does that for you. So it's really up to your preference.
Thank you. Yeah. Okay. Well, thank you so much. I really appreciate it. And I think I might have to grab your details offline if I can. Cause
It'd be a pleasure. Yeah.
You've just reminded me that I really need to just actually do something and make a decision.
That'd be a pleasure to chat more.
Well, we can put you in touch, Renee, but I think a massive thank you for sharing the portfolio with us today and asking your questions in such a public setting. Hopefully it's helped, and hopefully Matt or another advisor can help you more after this as well.
Thank you very much, guys. Appreciate it.
And just a reminder that if you would like to submit to Pimp My Portfolio, head to equitymates.com/contact. All the information is there. But if you'd also like to speak with Matt or one of our other advisors, head to equitymates.com/advice. There'll be a form for you to fill in, and we'll match you with the best and I guess the most appropriate advisor for you and your circumstances. So head to equitymates.com/advice.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.